So I'm delighted to welcome you to a unique panel. This panel is going to focus on the industry and capital market strategy for smaller cap shipping companies. We are just coming out of a panel that was discussing industry consolidation and M&A. And clearly, there are always benefits and synergies and economies of scale when you do consolidation and M&A. But at the same time, shipping is a fragmented industry, and I think smaller players can compete on more or less on equal footing with their larger peers. And these companies are quality companies with significant growth potential. Actually, the growth potential for a smaller company is much bigger compared to a larger peer. So here we have four actually listed companies, small cap, medium cap, and they will discuss their strategy. And we have Tate Sullivan from Maxim Group, the shipping analyst, who's going to moderate. So I would like to thank Tasos, Aslidis, Henry Williams, and Anthony Argyropoulos. And without any more delay, I'm turning it over to Tate to take over. And thank you very much.
Hi, thank you. And thank you for all the great events today. I cover shipping companies in Maxim Group's Equity Research Department, and our panel today is called Industry and Capital Market Strategy for Small Cap Companies. Happy to be joined by executives from four public companies, CFOs Tasos from Eurodry and Euroseas, EDRY and ESEA, CFO Anthony from Performance Shipping, ticker PSHG, and CFO Henry Williams from Pyxis Tankers, ticker PXS. Thank you, gentlemen, all for participating in the panel today. We have a good sample of shipping end markets on our panel, with Eurodry's dry bulk ships, Euroseas container carriers, and tankers for Performance Shipping and Pyxis. And with a focus on this panel on your industry and capital market strategies, I thought I would jump right in and start the panel today with this topic on business development strategies. And it's a good transition from the previous panel. And I'll usually rotate alphabetical by company name, but we can certainly mix it up. And all of your companies operate in global shipping industries. And Tasos, we'll start with you with Euroseas and Eurodry. Can you mention some of your competitive advantages for each of your listed companies with your current mix of ships and in your end market, please, to start?
Thank you, Tate, and thank you very much, Capital Link, for inviting us for one more time to participate in this very useful conference. I think Euroseas has been a player in the public markets since 2005 and listed on Nasdaq since 2007. We started being in both segments, both containers and dry bulk. And in 2018, we realized that we could unlock value by separating the fleets, and thus we spun out Eurodry on its own separate listing to develop and pursue its own strategy. For both companies, we believe that our competitive strength is really is based on the efficient and safe operations of our vessels. That has been the cornerstone of our sponsor, the Pittas family of Greece, for the last almost 1.5 centuries. We date back all the way back to the late 1800s. So building on the love for ships and on an efficient and safe operation, we are trying to navigate the quite challenging, I should say, markets, both on the shipping side and on the capital market side. Having that as a core, then we are trying to see what are the right assets to buy and how to best finance them.
Great, thank you for that overview. Shifting to you, Anthony, Performance Shipping, can you talk about some of your advantages in your end market based on the size of your company and ship mix, please?
Yeah, look, I think all four of us, I guess, if you count two for Tasos, we want to grow, the fleets, the operations of the company, achieve a certain degree of scale in our operations, which is critical. As far as performance goes, we are focused in the tanker sector broadly, starting with an Aframax fleet of 5 vessels. We have a stated goal to double the size of our fleet within the next 12 to 24 months. And I can tell you that what this is predicated on, for the most part, is the ability to access the equity capital markets to raise the requisite capital. We also have a clear strategy of having net leverage below 35%. So as you can appreciate, another 5 tankers means that we're going to primarily raise equity capital to fund our growth.
Turning over to you, Henry. Can you highlight your competitive advantages, please?
Yeah, thanks, Tate. Also, thanks to Capital Link for having the opportunity to participate in today's conference. Pyxis Tankers, as you may know, is a small product tanker company. We have 5 vessels. We really focus on eco MRs, primarily eco mods and eco-efficient, modern eco-efficient tankers to move a broad range of cargoes through many different ports throughout the world. Points of differentiation, really chartering strategy. We use a combination of time charters and spot. I would say in this type of market, we're really focusing more on short-term time charter. We think starting really the second half of this year, rates will improve and we'll have a better opportunity to participate in an uplift, which should hopefully be sustainable for the next couple of years from the standpoint of charter rates. Other competitive advantages would be our cost structure. We're very focused on daily operating costs. That really runs up and down the income statement. We have a model that is probably as efficient as some of the largest competitors in our business from the standpoint of cost structure. The last item I'd point out is management is very aligned with the shareholders, common shareholders, as it owns approximately 48% of the company. That is led by our founder, Eddie Valentis, who's been in the business his entire professional career.
Great, thank you, Henry. And shifting to you, Tasos, then besides focusing on the business strategies of all your companies too, looking at the public listing benefits as well for each of your companies in your and markets. I mean, with a broad question, and you touched.
I didn't hear the last couple of sentences, Tate. I don't know whether you can repeat. I can talk about the benefits of being public if this is what you asked, but I missed the last 2 sentences.
Yes, please. The benefits of being public.
I think being in the public markets, one thing that we enjoyed, I should say, is having lower cost of capital to fund our plans and our expansion, not only by raising money in the public markets as equity, but also getting some access to more sources of capital. We have been able to raise money in private transactions, and also by having, in general, lower cost of debt and greater choice of banks to fund that portion of our balance sheet. I think that's a distinct advantage that we saw. An additional and a supporting aspect to all of that from being public is that there is a transparency across the operations, and the availability of all this structure handily to potential financiers makes my life and the life of all of our executives in our company much easier by being public.
Great, Anthony. You mentioned before, and I hope you can hear me now too, the benefit of access to capital too. Are there other benefits that you'd highlight from your public listing, or also related to that, or if you wanted to comment on challenges too, please?
Well, obviously, look, I mean, it's not a matter of really challenging, but as you can appreciate, there's a heightened level of disclosure, reporting. It's more costly, but I think that the benefits far outweigh the disadvantages. As I said before, we look forward to accessing the markets. In addition to our fleet, I think, going back to your other question, I think we have a competitive advantage in terms of a very transparent corporate structure. All the functions are wholly owned. We too have a large shareholder owning 47%. We have one class of stock. There's nothing else, just common shares, no warrants, no convertibles, no other types of securities. And I think that the main advantage of being public is that you can actually invite investors to participate in your business, to grow the business. And based on our model, where we have a variable dividend policy, is when the rates are above our break-even level, we distribute the majority of that cash, back to our shareholders. In the last, I would say, despite the tanker market being very poor, in the last 3 or 4 months since we initiated our new business strategy and focused on the tanker sector and dividend policy, we have seen actually quite a lot of institutional interest.
Great. Henry, would you echo most of what Anthony mentioned?
Yeah, I would say so. I do want to chime in on a couple of things, a couple of other benefits of being public. One of the items would be obviously using our shares as added currency to potentially affect certain strategic initiatives, such as M&A work, whether you're acquiring companies or ships, more importantly, ships. You've seen that recently in 3 or 4 different transactions that have been completed across many different sectors within shipping. Also, the ability to have stock grants and whatever can provide long-term incentives for management beyond cash compensation. So those are 2 obvious things that are additional benefits. I would echo a number of the challenges from the standpoint of being a public company besides the cost. But when you really look at it, it is a situation you have to manage sometimes the volatility. Being a small stock, our stock can have huge periods of times where dramatic price movements, dramatic volume movements. Sometimes it's not, explicable, and it's a question of just pure momentum, day traders, whatever. And so there are certain times that you have to just, I would say, live through some significant volatility. You may be trading for a period of time significantly below NAV, and at other times significantly above. So that type of volatility clearly exists in more micro-cap shipping equities.
Is the positive listing, more visibility to multiple institutional retail investors too? And then, does it get on those days with your stock when it's moving rapidly? Do you have very active call volume, or do you just let it run on those kind of days?
Oh yeah, we will get certain calls, including NASDAQ and things like that, from a standpoint of monitoring. But I would say there's most of the time it's not tied into any press release or anything like that. It's just, I would say some herd mentality that occurs. It's as you probably know, Tate, last year approximately 25% of the volume on the U.S. stock exchanges actually occurred through retail investors, and whether that's direct individuals buying or program trading, whatever it is, it's retail linked. And so that, I think, for everyone in the shipping business is really a challenge, is how to cultivate, monitor that type of emerging channel, because that's dramatically different than 10 years ago, where you did find a number of long-only institutional investors. That game has changed.
Great, thank you. And Tasos, shifting back to you, you have the audience, the broader investor audience with retail and institutional by having the public listing, but I'm interested in how many times your public listing comes into conversations you have with your debt providers. Does it at all? Is it an advantage sometimes, pointing to your public listing and the more frequent financial reporting and public information, or is it not really part of a discussion?
I think it does play a role. I would dare to say a significant role. The banks we work with feel a lot more comfortable funding a public company. I think it's not the public listing alone that helps. Obviously, the track record of the company and the predecessors and the presence of the Pittas family in shipping are significant contributing factors. But the fact that there's transparency, as I mentioned earlier, and there is public markets to which the company can turn to raise additional equity if needed, all are comforting aspects of our presence to the banks.
Anthony, would you echo what Tasos mentioned in terms of do you talk about your share price and being a public company with your debt lenders, or is it completely separate from the conversation, or does it depend?
I think I would say that the actual share price is not something that comes up quite frequently. As you know, the lenders are primarily focused, it's asset-based lending, they're focused on the value of the asset, the financial covenants associated with a particular loan, and the like. And lenders have the luxury being in first position when things go wrong, just to expect the company to somehow fund the potential issues, be it a covenant breach or a repayment or a maturity. So in general, I echo what Tasos said. I think they feel more comfortable with a public company, particularly when we compare the size of the fleets that our companies have. If we were a private owner with 50 or 100 ships, it would have been different. But given the size of our operations, I think they're more comfortable with us being having access to public capital.
And is that the case with your company?
I agreed. I would say a majority of our lenders are happy we're public from the added disclosure standpoint. Also, the ability to potentially tap other forms of capital, which helps either sustain the business or help it grow. So in a general sense, I would say most of our lenders are very pleased that we are public, but they don't get into the share price.
That's right.
And also, I'm interested with you're the CFO of 2 listed companies. Do you find it improves your efficiency with all the different processes of being a public company, or is it no synergy?
I mean, the 2 companies are the evolution of a single venture that started with. So it is not, obviously they are being run and managed separately, the one from the other, but it doesn't add or subtract anything when we're dealing with the banks. I think we're pursuing parallel and separate strategies for each of the 2 companies.
And sticking with you two and the benefits of the public listing, I'm always, when you're negotiating shipping rates with customers as well, do they like negotiating with a company that has a public share price and more visibility, or does it matter in the conversations with shipping customers? I imagine sometimes they would prefer a company with more public financials than a private company, or is that not the case?
Yeah, I think that could be a benefit, but to the best of my understanding, I don't think it makes much difference when you're discussing a time charter contract, whether the company is public or not. I think it does help, it doesn't subtract, but I think really the focus of those deals are on the specifics of the deal, the vessel, the timing of the contract, and the rate.
I would agree. The only thing that I would say it might help is KYC. It's much easier from the standpoint of getting clarity because, as you know, these days, and we deal with obviously major integrated oil companies, major traders, a number of which are public, and they, as part of their vetting approval process, they're looking into, besides the vessels on all the technical aspects, they want to know, who we are, our reputation, and obviously having public filings makes that process a little bit quicker.
Is that the case with you as well, Anthony? As well, would you highlight?
Yeah, I agree. I don't have a lot to add in terms of the customers or the banks. Clearly, there are certain benefits.
Yeah, I think it removes any credit. I mean, you can evaluate the credit of the counterparty very easily because you are transparent and public. If you try to deal with small private companies, then in doing a deal, you get into the trouble of figuring out how creditworthy they are. With public companies, that is out there. So that is a benefit, of course, for facilitating the overall transaction.
Can you, shifting gears a little bit and staying with you, Todd, can you talk about when you entertain and evaluate potential ship acquisitions and acquiring other companies that may have multiple ships, is talking about your potential issue capital, issue shares as part of that deal right at the forefront of the conversation, or how do you usually approach introducing your shares as currency in acquisition?
I think that depends on the situation and depends on the strategic objectives of the deal that you are trying to evaluate. I think in some cases you have to do an outright purchase, go through the normal channels and offer cash. In certain other cases, especially if there are potential synergies or potential plans of growing together, you could invite or you could offer to the previous owners the possibility of getting paid partly in shares. I think we did a couple of transactions of that sort in 2019. Euroseas increased, more than doubled in size, and definitely more than doubled in terms of value by paying partly in shares for a total of 8 vessels, and which have become the core of the nucleus of our current fleet. And they were quite successful transactions for us as well. But those were started by being intended to be partly shares for vessels deals, and had that feature in them.
Anthony, can you share an anecdote, a story, or using shares with an acquisition or evaluating, or how you usually proceed with introducing shares as capital in acquisitions?
We've had, we haven't actually done this. As I mentioned, even though the company has been listed since 2011, it was mainly the container ship sector, and it went through a divestment program between 2019 and 2020. So effectively, we've been a pure tanker company as of Q4 of last year, rolling out a new strategy, business strategy, as well as management. We have received proposals to do so, to use the stock as a currency to acquire assets. Because our business strategy is, as I said before, incumbent on raising equity capital to grow. Whether we raise that capital directly in the public markets or whether we issue that stock to the seller, in a sense, it's one and the same. If we can enter into a larger transaction on a multiple number of vessels where stock is involved, then I think that's where issuing stock to the seller of the assets plays a more important role, and we're obviously very willing to consider that.
Henry, would you like to add anything?
Yeah, the only thing I'd say is obviously cash is king, but the situation of utilizing our stock, really it sort of depends upon both parties' perspective. Where we are from a standpoint of current stock price vis-a-vis our net asset value. At the same time, the other side, looking at their perception about our stock, its liquidity, their near-term registration rights, and their ability to hold and potentially appreciate with our stock. So it's really, I would say it's always the discussion about having stock as part of the equation to make acquisitions. It is a secondary perspective beyond looking at the cash component.
If I can add, Tate, if I can add a comment here to what Henry said and to that discussion, I think another aspect of this type of transaction, shares for vessel, is at what price you value the shares. I think all of us are aware, and I'm sure you're aware, that ship owners, especially I would say of smaller companies, tend to look at the net asset value of the shares as a reference point and are quite hesitant to issue shares at below that. So sometimes it's a great weapon and a great option to have to issue shares for ships. But some other times it's not really something that you are willing to do because of a discount that the shares are trading, and that might limit the usefulness of the option.
Mm-hmm.
Right, and shifting back to, and many, thank you for all the comments on the benefits of having a public listing too, and talking more about business strategy side. Could we talk a little bit about your current outlook in your end markets, and given where we are today? And Nick mentioned earlier, many of the panels have been very positive throughout the day. Do you echo that sentiment in terms of the positive outlooks in your end markets? And I'll open it up to whichever one of you wants to comment first on the end markets.
I'll jump in. Product tanker business right now, rates are obviously very depressed, and it's been a difficult period of time, especially since the impact of COVID and the on the demand side of our business, especially in relation to transportation fuels. And so right now it's a tough period of time. I think there is a belief, and we are fully supportive of that, come the second half of this year with the improvement of vaccinations, return of economic activity. And we've already started to see that in Asia, is that demand is going to pick up, and consequently we look for an improvement in charter rates, utilization factors. That should be obviously very helpful from the standpoint of revenue generation. I would say at the same time, the order book looks very good for our business. And what I mean by that, you're going to see a net supply growth this year in the neighborhood of about 2.5%. So when you lay in good demand growth, especially in the latter part of this year, moving into 22 and 23, we think the outlook for our business looks pretty solid. But again, time will tell. And so the real issue for us is the demand side and how that affects charter rates.
Let me just add to, because since we're in the same, similar, I guess, same sector, we just operate crude oil tankers for the time being. We haven't invested in the product tanker sector yet. It was a very interesting year. If you think about it, beginning of 2020, Q1, we saw Aframax tanker rates in excess of $50,000 a day. During the fourth quarter of the same year, we saw rates below $6,000 a day. So the volatility that we've had has been, I think, almost unprecedented within such a very short period of time. I agree, and obviously it's very noteworthy that in the absence of a supply, meaning a large order book, typically the industry does well. What we need in the tanker sector is basically we need more barrels of crude oil as well as refined petroleum products to be produced. And as you know, because of the sensitivity in demand, the decline in the prices, production had been curtailed significantly. We are, I believe, in the onset, particularly with the news about 1.5 million barrels coming back in production later this month, of increasing charter rates and actually seeing fundamentals lined up quite positively for the tanker sector, crude oil as well as refined petroleum products.
I can add a couple of words for the two sectors that we are active in. We are quite optimistic for both sectors, and I think we're optimistic primarily because of the supply side. On the dry bulk side first, the order book to fleet ratio being below 6% right now, I think it's one of the lowest, if not the lowest, in my career that I have seen in shipping. I deal with the industry for a good part of the last 30, 35 years, and I don't recall the order book to fleet ratio being below 6%. So that sets the stage for the sector to do quite well if, of course, and I want to stress the if, demand grows with the normal historical trends. We are stepping out of the COVID-induced recession, which is a good thing, but also we have to face certain trends, the decarbonization and the reduced use of coal, the intended reduced use of coal over the next several years that could go against the trade growth. But overall, I think we see a couple of years that the market could really, I don't want to use the word explode, but it could really do very well if demand returns to historical norms. Similarly, on the container ship side, we have an order book that is quite low by historical standards. It was recently 9%. It jumped up a bit now. It's between 10 and 11% because of some orders placed. But there we have some inefficiencies in the system, at least in the short term. We have slow steaming that could keep the supply growth low for the medium term. And again, stepping out of the recession, we should expect to see solid demand for finished goods and their transportation. So in both sectors, we expect to see, at least in the near term, very good markets, hopefully going beyond that, depending on how many orders are placed.
And I would also add, if I may, that this is already recognized by the institutional investor community, equity research analysts. Over the last, I think, 30 days or so, you're now hearing a bit more about technology taking a backseat to old economy sectors. You're talking about massive stimulus packages. You're hearing about a significant amount of pent-up demand that will manifest itself over the next few months as people become more mobile, if you will, and are being transported more. So I believe that we are, it's the onset of an age of higher global growth, asset-based industries, if you will, commodities in general. And usually this is an environment that is quite supportive for the shipping industry.
Henry, would you like to add? Well, we talked about the end markets exposure, and I'm interested, since we have a unique opportunity to have CFOs of 4 companies today on the panel. Can you share, as being in charge of the public company, financial reporting, where do you spend most of your time? Does it fluctuate over the course, or where do you find yourself spending most of the time, or where would you like to spend most of your time?
Well, I think, but more recently for us, given the fact that we did a public convertible offering last fall, and we just did a private placement of common stock, we've been very active in the financing arena within the last 4 or 5 months. We expect to put that money to good use from the standpoint of acquisitions, restructuring some of our debt, paying down some of our debt, let alone just fundamentally improving our balance sheet, lengthening some debt maturities, things like that. So I think for us, we're looking forward to an opportunity to deploy that capital very accretively and effectively to help position us for further growth, especially with the recovery that we envision later this year, hopefully lasting the next couple of years. And so that should be good for our shareholders.
That was a form of a closing statement. I'll circle back to you if you want to add something else on that, but I want to give Tasos and Anthony, we have 3 minutes left in the panel too. Tasos, is there, what would you like to leave the listeners with about your Euroseas and or Eurodry?
I think we spent, at least from in my sector, we spent the last year in trying to make sure that our balance sheet will withstand any unfortunate developments in the market as they seem to be happening right after the pandemic kicked. Towards the end of the year, we switch gears and try to make the balance sheet a little less costly by reducing the cost of some instruments that we have, like the preferred, and refinancing some of our ships to release some liquidity. And we always try to have a disciplined way of trading and analyzing the deals. I think this is one thing that I'm proud of, that we instill in the company over the last 15 years, that all the deals we analyzed in a consistent way and trying to be disciplined whether we buy or sell ships. And that has helped us navigate well the last 15 years.
Anthony, what would you like to leave listeners with today?
Well, I'll say that I'm very excited for performance shipping. We expect that the markets will be firm, and as a result, we'll be able to grow our fleet, raise additional equity capital to do so, and at the same time, pay dividends to our shareholders. We have a variable dividend policy that is unique. We will be able to distribute cash flow above certain thresholds and pursuant to a very, very specific formula that we will articulate along with our Q4 results shortly. And as a result, we really look forward to returning capital to our shareholders as the cycle unfolds, and at the same time, growing the fleet. As I said, we have a target of doubling the size of the fleet in the next 12 to 24 months.
Well, excellent. And don't want to, Henry, if you wanted to interject with anything additionally, but it's been great hearing from all of you with all your different end markets as well too, and all the benefits of having the public share capital related to evaluating acquisitions and financings And I'm sure, and thank you for your time today, as I know you all have been very busy in this type of market, I can imagine.
Super.
Thank you, Tate.
Great. Thank you very
Thanks.
much. Thanks,
Right,
Tate.
be well. Right,
Bye,
bye-bye.
guys. Thank you.